welcome the students. So now the next thing which we are going to discuss and would like to learn about is the financial estimates and projections. That's the next part of the analysis for the new projects, for the project selection as well as for the project acceptance, planning and acceptance. Finally, the venture which we are going to accept or we are going to move into or going to make the investment in. Next thing, that is the third important analysis, is the financial estimates and the projections, because financial estimates and projections play a very critical role. Under these financial estimates and projections, what we do is we try to estimate all kind of the investments we are going to make for the requirement of the fixed assets, or maybe for the working capital estimates and for the requirement of your current assets. So all kind of the investment requirements for the fixed assets, for the current assets, including working capital and all kind of the investment estimates. That's the one requirement of the financial estimates. And second requirement is the projections, and projections include the preparation of the three projected financial statements. First projected financial statements is the income statement, which we call it as the profit and loss account also. Second projected statement is the cash flow statement, and third projected statement is the balance sheet. So we make projections, we go for preparing the projected, say you call it as the dummy financial statements, proposed financial statements, projected financial statements, that in the first year how much is going to be the production and how much is going to be the sales level, what would be the profit or loss situation. Second year, how the situation will change, maybe improve or go down or anything like that. Third year, what will be the situation. Fourth year, what will be the situation. And by making all these projections about the profitability, by preparing the projected profit and loss account or income statement, we want to know about that by what time, by which year of the project or the venture coming into being, the project will come into or will arrive at the break-even point. A situation, break-even point means a situation of the no profit or no loss. That is the first and the foremost requirement, that within the minimum possible time, the project must reach at the break-even point. Because after break-even point, whatever the production we are going to make, that's going to give us the profitability. So, and the profitability will only start after the break-even point. So, attaining of the break-even point is very important and the critical requirement of for the success of any venture or for any enterprise. Maybe it's a startup, or maybe a project by some existing firm, or maybe it's by some any other group of the entrepreneurs. But attaining the break-even point at the earliest is the first and the foremost requirement. Even the investors, maybe they are the angel investors or the venture investors, or maybe the say the private equity providers, or maybe institutional investors, wherever we would like to go, you have to give a presentation to them, showing them that what is the project idea, how you conceived it, how you conducted the market and demand analysis, how you conducted the technical analysis, so that the total maybe, because market and demand analysis will give you the output information and the sales possibility in the market. Technical analysis would largely be giving us the information about the investments required to be made, and all kind of the say you call it as the outflows from the projects. Market and demand analysis will be giving us the inflows from the project, and finally this comparison of the outflows and inflows will be helping us to go for the financial projections. So all investors of any kind, whether they are angel investors or whether they are the venture capitalists or whether they are private equity providers or any form of the investors, they are more keen to know about that what is going to be your profitability situation, what is going to be your cash position, what is going to be your financial position at the end of the day. And the ventures or the ideas or the projects which are going to arrive at the break-even point within a given span of time or at the earliest possible year, that projects or those kind of the ideas are the most acceptable and welcome ideas by the venture capitalists or by the angel investors, even by the private equity investors also. They are going to like those kind of the ideas, those kind of the ventures which are going to arrive at the break-even point at the earliest. So this is the first and the foremost requirement. So by preparing the projected or dummy financial statements, projected financial statements, you are going to get to know the period or the year in which the firm is going to reach at the break-even point. So that's the purpose of your projected profitability statement or income statement or say profit and loss account, so that we can get to know about the profit or loss situation of the firm, and after how many years of coming into being, the firm is going to earn the profits, and the profits are going to increase at what pace? Or it's going to remain at the static, maybe a level which is called as a static, or they are going to grow. If you draw a line, so is it giving us a static line, or it's giving us a declining trend, or it's giving us a rising trend as far as the profits are concerned? So projected financial statements are very, very important, especially the projected income statement. You understand now what is the source of projected income statement? The source of projected income statement is basically the market and demand analysis and technical analysis. On the debit side of the income statement, you will put all the cost, and all the cost means all your fixed cost as well as the variable cost. First, you will put the variable cost in the form of the in the form of the material, labor and other direct expenses. Then you will come down, you will put all your factory expenses, you will put all your financial expenses, and you will put the expenses, part of the fixed cost, in the form of depreciation. So, debit side of the profit and loss account will contain all expenses, the right side would contain all incomes. And income source is what? Income source is basically the sales, and sales are possible to be known by market and demand analysis. So, technical analysis is going to help us to estimate the cost, the debit side of the profit and loss account or the profitability statement. Market and demand analysis is going to help us to have the values of the credit side or right hand side of the profitability statement, and comparison of the left hand side with the right hand side or vice versa is going to give us the difference, and that difference is called as the profit or the loss. So, if the credit side is bigger than the debit side, if the market and demand analysis estimates in the form of the sales are going to outweigh the cost, which is given cost estimates given by the technical analysis, then certainly the firm is going to end up the profit in that particular year. But if the debit side cost is going to say exceed the sales estimates, in that case the firm is going to end up at the losses, and that profit and loss situation has to be managed. So, first we will arrive at equal state where the income is equal to the expenses or vice versa, and finally we are at the position of the no profit or no loss, which is called as a break-even point. And after that we will start earning the profits. Once we reach at the break-even point, process continues, sales continues, means production continues, sales continue. So, the difference between the sales and cost will also maximize, and that the profitability of the firm will also go up. Next thing is the cash flow statement and the balance sheet. So, as we go for the preparation of the projected income statement, similarly to know about the cash flow position of the firm, we prepare the cash flow statement, and to know about the financial position of the firm, we will prepare the projected balance sheet. So, all these statements we will discuss one by one in the subsequent lectures. So, we will because we have started the discussion on the financial estimates and projections. So, let us talk about what it actually includes. What is the subject matter of the financial estimates and projections, which basically is called as the financial analysis. So, we have done the market and demand analysis, we have understood the technical analysis, and now we are going to understand the financial analysis in detail. So, in the estimation of the finances, the cost and as well as maybe the profitability projections, we have to have the number of points to be considered here. And first of all, the first important point in the outline of the financial estimates and projections is the cost of the project. Cost of the project basically talks about the all fixed assets we are going to create, land, plant, building and machinery, and how much investment we are going to make in building that project. How much long-term investment we are going to make in building the project, that estimate is important for us. And as I told you that in the manufacturing areas, manufacturing sectors, when you want to manufacture a product, so in the manufacturing process, you need to have land, plant, building and machinery. You need to create the fixed assets. So, it causes a cost. It causes a big investment also. So, for that purpose, you have to be very careful that cost of the project will be very high, and we will go only for say creating the venture or maybe setting up of the project if we are sure about that the outcome of the project is easily saleable in the market. So, first component is the cost, which will be incurred for creating the fixed assets of the firm. Next thing is the means of financing. How would you finance your creation of the or maybe setting up of the plant, land, plant, building and machinery, or maybe raising of the fixed assets? How would you be financing it? Different sources of the funds are there. We have the largely if you divide it into, they are the internal and external sources of the funds. Internal sources of the funds are equity and reinvestment of the profit, and external sources of the funds are basically the borrowed funds, right, coming in the form of the debt. There can be other subsets of the finances also, but broadly if you want to talk about the means of financing is, it can be broadly talked about is that we can have the funds either from the internal sources or from the external sources or from both. So, what is going to be the means of financing? That would be the second point of discussion here. Next thing is estimates of sales and productions, because you want to go for the profitability projections. So, you would like to have the estimates of sales and production. So, sales, estimation of sales are going to be supported by the market and demand analysis, as I told you just now, and production is going to be supported by the technical analysis. And comparison of production and sales or vice versa is going to give us the revenue position of the firm, the cost position of the firm, and difference between the revenue and the cost is going to be the profit or the loss. So, if the revenue is more than the cost, right, so we are ending up at the state of the profit. But if the cost is more than the sales, or if the cost is more than the revenue we are going to generate out of this venture, then we are ending up at the state of the loss. So, one day we have to convert that loss into profit. How far is that point, and how quickly we are going to achieve that point, that is very important for us. Next thing is the cost of production. Cost of production is going to be worked out on the basis of largely the total cost of the product, which has two components, variable cost and the fixed cost. Variable cost is included or maybe is caused by the raw material, by the labor expenses and the other direct expenses, and then some indirect cost including depreciation and the financial cost. So, cost of production is both, is the sum total of the fixed cost and variable cost, or the variable cost and fixed cost. So, we will have to go for production, we have to give shape to the product, we have to come out with the production. So, we will have to incur the cost, and for that we have made some investment, created the plant, building and machinery, set up the project, and when this production is going to go to the market, is going to give us the sales, is going to give us the revenue, and we are going to compare the sales with the cost and cost with the sales and find out the end result. Next thing is the working capital requirements and financing is a very, very important component of the overall project management. Many projects fail, many ventures fail because entrepreneurs forget to make the proper estimates for the working capital requirements. They are very careful in making the estimates that, for example, if you want to manufacture a product, so how much investment is required into land, plant, building, machinery and other things, right. So, they make the estimates for that, but they forget to make the proper provisions for raw material, human resources and other direct expenses, or maybe the short term or the current expenses for the power, for the water, for auxiliaries, for utilities, all these things. So, if the sufficient working capital is not there, you are not able to arrange the raw material, you do not have the sufficient human resources, you do not have the sufficient utilities, you do not have the sufficient auxiliary products. In that case, you are not able to utilize the plant to the fullest capacity. And if the plant is not misutilizable to the fullest capacity, so what is going to happen? You can understand the firm is not going to arrive or maybe to enjoy the economies of large scale production or maybe the medium scale production. And in that case, there is going to be a very, very difficult situation. So, as a very shrewd entrepreneur or maybe as a smart entrepreneur, you have to be very careful that apart from the estimating for the long term requirements for the business, you have to at the same time very meticulously estimate for the short term requirements also, working capital for the firm also. Working capital itself is an independent area of learning, right. When you learn the financial management of the firms, especially the corporate finance. So, in the corporate finance, we divide the corporate finance into two components. One is the study of the long term management of the long term funds, and second is the working capital management or learning about the management of the short term funds. So, always be careful that if you want to be a successful entrepreneur, always make a proper and better estimates for the working capital requirement along with the requirement for the or estimation for the requirement of the long term funds. Profitability projections, I am emphasizing upon this since the beginning of our discussion in this class, that profitability projections is going to make a difference. And we are going to know by projecting the profitability of the firm when we are going to reach at the no profit no loss situation, that is a break even point, when we are going to start earning the profits, and what is going to be the shape of that trend, profitability trend. Is it going to remain static, going to go up, or going to go down? So that is a very, very important trend for us. So profitability projections are very important, and for having the better profitability projections, we will have to estimate carefully the cost component, the sales component, and compare both the revenue as well as the cost, and try to find it out what is the state of the profitability. Normally, the decision making for the investors, maybe they are angel investors or venture capitalists, or maybe anybody going to provide you, come to join the project as a private equity provider, their requirement is that any venture who is going to be a successful venture, maybe in the medium or long term, must reach at the break-even point at the end of the third year. Maximum at the end of the third year. There can be loss in the first year, fine, acceptable. There can be loss in the second year, fine, acceptable. But if there is a loss in the third year, again, to some extent acceptable. So normally, every successful venture must arrive at the break-even point at the end of the third year, means at the state of the no profit or no loss. But in any case, for example, if it is not possible at the end of the third year, in any case, it should be possible at the end of the fourth year. Any venture which is not reaching at the break-even point at the end of the fourth year even, I think the investors will not have any interest in that particular idea. They will not like to come forward and make investment. So always make it a point that I will not go up to fourth year. I will try to make sure that at the end of the third year, I am at the break-even point. And from the fourth year onwards, I will start earning the profits. My project will start earning the profits, and those profits will keep on growing because my production will be under control, my sales will be growing, and we will be expanding the markets also. We will be enjoying the economies of large scale production also, and finally, we will be creating our own presence in the market, and our market will grow, and our sales will grow, our cost will be under control, and profitability will be growing. So that kind of the mindset will help you. Those projections will help you to get the better investors, good amount of the funds also, and to establish yourself in the market as a good entrepreneur also. So next statement is the cash flow statement. Cash flow statement has become very, very important statement after the profitability projections. And the profitability projections play a very, very important role that we all understand. But cash flow statement also plays a very critical role. Earlier, there were only two statements, profitability statement and balance sheet. There was nothing like cash flow statement. But from 1997 onwards, in India as well, we have started preparing the cash flow statement, and now it has become the very important third statutory statement to be prepared by every company, and mostly the public limited companies which are listed in the stock exchange. For them, it is must, and even for the privately held companies also who are not, let's say, having any funds from the public in the form of the public equity, or who are not into the, say, raising the funds from the public and who are not listed in the stock exchanges, if they are privately held companies, for them also it is always better to have the cash flow statement. Cash flow statement serves a very, very important function, because profitability statement tells us about the profits, right? But that statement is not communicating to us whether that profit is in cash or that profit is not in cash, right? Because profitability, or maybe the profit as such, is something called nominal value, having a nominal value, not the real value. Because when we talk about the profit and loss account as a statement, we call it is a nominal statement. It's not the real, it's not depicting whatever the outcome of that statement is, that's not going to be real. Because whatever the sales we are going to make, those sales can be on both bases. It can be on the cash also, it can be on the credit also. So that profit and loss account is not going to help us to understand whether the sales are on cash and what percentage of the sales are on credit, what percentage of the sales are on cash. That's not going to help us to find out. That's only talking about one thing, which is called as sales. Now you understand that, for example, for any venture, larger part of the sales are on credit. 80 to 90% of their sales are on credit. Right, 80 to 90% of their sales are on the credit. It means 80 to 90% of the projected profit will also be on credit. That's not the real profit. That's why we call the profit and loss account as the nominal statement, not as the real statement, because profit or loss depicted by that statement is only nominal. It's not real. So, to supplement that nominal profit or the loss, we prepare the cash flow statement. For example, your profit and loss account is showing that we are earning a certain amount of the profit. But how much of that profit is in the form of cash? So if you know the accounting process, you would ask me a question that the closing balance given in the balance sheet is also going to tell us that what is the cash position of the firm. Because in the balance sheet also we have the closing cash balance, right? We have a closing balance of the cash in hand and cash at bank, which talks about the cash balance. So if the profitability is not in the form of the cash, so the closing cash balance in the balance sheet will not be sufficiently high. So it will give us a very good idea to understand that larger part of the profits are also on the credit, not on the cash. So we have to be very careful in dealing with that kind of the business or that kind of the firms. But still we need the cash flow statement, because there may be a high balance of cash in the balance sheet. High amount of the profits, but the high amount of the profits is larger part of the profits is on the credit, because larger part of the sales are on the credit. But if you check the balance sheet, the closing cash balance is also high. So you would be confused that the firm is selling larger part of its sales on the credit, but still the cash balance in the balance sheet is high. So what is the source of the cash? So to know about the detailed source of the cash flow statement is important statement, and preparing the projected cash flow statement is the ultimate requirement. Cash flow statement, when we are preparing these days, that is helping us to understand what is the source of the cash from the operations of the firm, what is the source of the cash from the financing sources of the firm, and what is the source of the cash from the investing activities of the firm. We are preparing it under three activities: operating activities, investing activities, or financing activities and investing activities, right? So it tells us in detail what is the state of affairs of the operations of the firm, what is the state of affairs of the finances of the firm, and what is the state of the affairs of the investment activities of the firm. So if the larger part of the closing cash balance existing in the balance sheet and the profits are not, profits are there, but the larger part of the profit is on the credit, so the cash flow statement will tell us that whatever the closing cash balance you are finding in the balance sheet, that cash balance has not come from the operations of the firm, but from the other sources. That might have come from finances, or that might have come from the investing activities. And in any firm which is into a manufacturing process, but the larger part of the cash is flowing from the activities other than operating activities or operations of the firm, it means the operating structure of the firm has become a sick structure. We should not deal with that firm. We should stay away from that firm. So the investors at the time of presentation given by the entrepreneur to the investors, maybe they are the angel investors, venture capitalists, or maybe any other kind of the risk capital investors, they will have to be convinced that what is going to be the sales level in the first year, second year, third year, and when we are going to reach at the profit or the loss state. What is going to be the cash position of the firm over these number of years, first, second, third, fourth year. And third statement is the balance sheet, that what is going to be the state of the financial position, which is depicted by the balance sheet. So profitability statement is going to talk about the profit or loss position of the firm. Cash flow statement is going to talk only about the cash position of the firm and sources of the cash. And third, balance sheet is going to talk about the financial position of the firm. Balance sheet, as the name indicates, at any point of time, maybe not at any point of time, but on the last date of the accounting period, balance sheet must present a balanced picture. Your asset and liabilities must be equal to each other on the last date of the accounting period, and both the sides should be equal, and it must balance. One day before the accounting period or one day after the accounting period, it may get disturbed. But on the last date of the accounting period, if the last date is 31st December or 31st March, on that date the balance sheet must be must present a balanced view, right? So profitability, through profitability projections, means through profitability statement. Cash flow statement is going to give us the cash position and sources of the cash in the firm, and balance sheet is going to tell us, to help us to understand the financial position of the firm. So, these three projected financial statements will be prepared under the financial analysis, under the financial estimates and projections, so that you can give a presentation to the investors and you can tell them that at the end of the third year, my firm is going to reach at the break-even point, my cash flow position is going to be comfortable, and my financial position is going to be balanced all the times, right from the first year till the year of reaching at the break-even point and in the subsequent years. So, all these projections are very, very important for us, and on the basis of the projected financial statements, we can decide to go ahead. So, now let us talk about this structure. This structure is very, very interesting and very, very useful for us to understand, right. So, this structure is again talking about certain important things, and it is talking about the, say, the profitability statement is talking about the cash position, and is talking about the financial position of the firm, right. So, when you are talking about this part, so we will be talking about the, say, this part, cost of project and the time phasing. That is one important thing. But when you talk about this, say the cost of production is a very, very important consideration for us, and this is going to be known from the profitability statement. And finally, the cost of production, and we are going to compare it with the projected sales. So, when you are comparing the cost of production, projected cost of production with the projected sales, so we are going to get to know about the difference, and that difference is going to be the profit for us. And how much is that difference? Initially, the cost of production would be higher and the sales value would be lower. We would be at the state of loss. Over a period of time, both these sides will become equal to each other. Cost of production will be equal to projected sales, and we will be at the break-even point. And after that, situation will reverse, where the projected sales will be increasing from the fourth year onwards or fifth year onwards, and cost of production either remaining static or going down, because economies of large scale production and the difference between the projected sales and cost will be maximizing. So, we will be now in the state of the profit. After that, once we have the profit idea from the projected profit and loss account, then we will be preparing the cash flow statement also. So, cash flow statement will talk about the cashability of the profits or the cash position of the firm, and third statement is the balance sheet, which is the ultimate statement, which is the third and the last statement in the financial projections, and that is going to help us about the financial position of the firm, that asset and liabilities are equal to each other, and the firm presents the balanced view. The balance sheet of the firm presents a balanced view. So, to prepare these three statements, profitability statement, cash flow statement and balance sheet, other factors play a very, very critical role. So, for example, means of financing is going to tell us about the financial cost in the form of the interest component, right. Working capital estimates are going to tell us about that how much investment we are going to make in the material, labor, direct expenses. So, how much funds are required for that, and where to arrange these funds, working capital, where to arrange the working capital from. Because if you do not have the working capital available, you cannot have the material, you cannot have the labor, you cannot have the direct expenses to be paid for the power, water and other utilities. So, miss provision for that, and maybe these provisions cause a cost. So, taking them to the say cost of production side and then comparing it with the projected sales. So, we will get the projected profitability statement, cash flow position and the balance sheet of the firm. And tax factor also plays a role. So, finally, we calculate the profit before tax and profit after tax. So, if the tax component is higher, certainly your the profit is going to be lower in the beginning years, maybe from the fourth year onwards. And maybe if it is a loss making situation, so there is no tax to be paid because we are at the state of loss. But when we start earning the profits, tax factor is going to play a very, very critical role. And if the tax is higher, so maybe the net profit after tax is going to be lower with us. So, this is the relationship between the financial projections, and to a larger extent, because you need the funds for setting up of the business. For that purpose, you go to the different sources, and initially, because the venture is new, so you go to the venture capitalists, to the angel investors, or maybe the people who provide the risk capital, maybe, right, in the form of the debt or equity or whatever it is. You have to go to them, and when you go to them, So you have to go with the financial projections. You have to go with the detailed project feasibility report. But miss, in the detailed feasibility report, they would be more interested in the financial projections. There you will tell them that this is going to be my state of profitability, this is going to be my state of cash, and this is going to be my financial position, which will be based upon your idea of the business, market and demand analysis, and technical analysis. If the market and demand analysis has given you the better results, cost is going to remain under control, which you have known under the technical analysis, certainly the financial projections would be better. And if you present a very good financial projections, or maybe the very rosy picture in front of, which is based upon the facts, rosy doesn't mean that something not based upon the facts. If you present a very positive and a very, you call it as a healthy picture of the firm in front of the investors, they would be very happy to make investment, give you the risk capital, and you would be able to get the easy money, or you would be able to invest that money in your business along with your own funds. And then if everything goes well, then finally the firm will arrive at the break-even point at the earliest, and it will start earning the profits and start growing in the market. So for the financial estimates and projections, we will stop here for this class, and subsequent discussion, the remaining part of the discussion, we will have in the next class. Till then, thank you very much.